All righty. Well, we're here for episode 5, which we got some change ups for everybody who's out there this week. I am in New York for MBA secondary, hence the background, because I'm in a crappy New York hotel and you don't want to see the actual background. Unfortunately, our original guest for today had some family stuff and is not able to join us. But the great John Levonick, thank you so much for jumping in. Great seeing you yesterday at secondary. Which for those of you who aren't, who are watching and are not out at secondary, I gotta say it's energy is really good out here this week. Good crowd. There's a lot of people. I don't remember seeing this many originators at secondary. John, I don't know if you have any opinions on
Yeah,
that.
yeah. There was it seemed like a lot more originators than normal. I mean, it definitely shows that the front end of the market is looking to get non-QM channels. I would read the tea leaves. So I think it's a lot of non-QM interest, and it's good to see the originators out there. Hopefully, something came of it for them.
Well, and everything I heard from all of my meetings so far is that there is a tremendous amount of capital that is being pushed into the non-QM market. So getting these, bigger warehouse lines for non-QM seems to be, I don't want to say easy, but that was sort of the vibe that I sort of got from it. So from this week. So anyways, super exciting. And we're also kind of seeing, a lot of vendors that are out here, in the AI space and what they're doing. So, what I really wanted to talk a little bit about today, and, we're going to cover some mortgage tech stuff, but I also, John, want to sort of talk about some security stuff. And again, anybody who's watching, please feel free to drop any questions you have in the chat. Again, today we don't really have much of an agenda. We're just randomly talking about stuff. So, Mace, what are you hearing, or any sort of like scuttlebutt, if you will, from the market that we're hearing about stealth companies, right? Like I ran into, God, I don't know, I think I ran into like 3 or 4 different people just yesterday who are working on stealth projects. Who of course wouldn't tell me that much because it's stealth. But I'm kind of curious if you're hearing anything of like where the ball is kind of bouncing in mortgage tech that's interesting.
So I don't know a lot of these guys 'cause I'm doing my own stuff. Every time we talk, I'm telling you about a new thing I'm doing. As soon as you started asking that question, I was like, oh shit. But
Let's talk about what you're doing. Do you want to talk about what you're doing?
It's stealthy. I do think we are playing around with some AI underwrite, but we're actually just kind of putting in the pieces that some of these other tools are offering. And so but you just said something funny, Andrew. It's like this company called Techmore. Never heard of them, and then it was like, how has this thing been sleeping under the radar? When they do some AI underwriting. But while you're at the secondary, what is secondary like? It seems to me like that would be OB, Poly, Linda Price. Like this is their Super Bowl, right? Or do they go all out?
Okay, so here's what's so funny. Here's the weird thing about MBA secondary, which is most people don't register. So it's a weird conference because of the fact that it's in New York and it's in Times Square, right? Which is like one of my least favorite places on the face of the planet. But all of the investors that people want to meet with, they're not actually at the conference,
so
right?
They're doing the suitcase, is what they call it.
Yeah. So like, yesterday I was at the Harvard Club. I was at the W. I was at, where else did we go? You're just kind of all over the place, right? And some investors, they're so close to the conference that they just make originators come to their offices and meet with them in their offices. So you get a lot of people. Like if you go to the 8th floor lobby of the Marriott Marquis, it is a who's who crowd of people who didn't register for the conference. I probably shouldn't even say this out loud. I've never registered for this conference. I've been to it like 12 times. So it's really kind of interesting. It's sort of hard to tell. But it used to be, at least the way I always saw it, was exactly what you feel like, right? Which is, well, we've just got secondary vendors that are showing up to this. But we, again, as John was sort of confirming, we're starting to see a lot more faces from the origination space, which I think naturally pulls in a lot more vendors that are more focused on the origination space. Like Zactus, I ran into those folks yesterday and chatted with them for a little while, right? And all their products are AI focused for originators, not for secondary. So it is kind of interesting to see how the conference has changed.
And is there any tech in the secondary space that is being worked on right now, or that you're aware of?
No, I mean, well, a little bit. John, you've got some insights here.
Yeah, I mean, Andrew used the term stealth. That's the term I come across quite often, which I interpret to mean we're trying to prove our concept with AI. We've formalized an entity, and we're trying to take traditional processes and leverage AI to deliver a solution we think AI is capable of delivering. So that's my interpretation of the term stealth. But yes, there are, there's two types of persons with regard to capital markets technology. There's the technologists who have never been in the space, who see consumer finance, mortgage lending, consumer lending as a prime area to disintermediate and go after with technology, right? They see that the bar is very low from a technology perspective, and there's a great way to bring value. But those participants aren't industry, the familiar faces from the industry. And then there are the familiar faces from the industry who are trying to wrap their head around technology and trying to reinvent the wheel on the shoulders of AI. So yeah, there are new faces, there are old faces, but it's interesting. In the last couple of years, I've seen a lot of people enter the space, and they're kind of referred to as which university or which CS program they came out of recently, and they're attempting to deliver products. We've seen some successful penetration in the place. I remember years ago where a company like Qualia. Qualia was led by a gentleman who's right out of undergrad or grad school out of the university, who was able to build a product, not know the space, navigate it, and bring forth a meaningful capability. So it's a mix. It's a mix of old and new. There's a lot of, oh, I heard of that product, or I've heard of that guy, or I've heard who is that platform. So there's a lot of the traditional folks trying to figure out who's who in the walking around of, who's doing what effectively.
It's also, Mace, it's a very different landscape when you start working within the secondary market for tech, and for a couple of reasons, right? Number one, and the biggest one is, when you're when you're one originator and you're looking like, okay, how do I streamline my processes? How do I, introduce AI? Like, you've got you should have a fairly static data set, right? That doesn't really morph that much, right? I've got one friend at one of the investment banks. They have 147 originators that sell into them.
That's crazy.
So you're dealing with 147 different, we all know everybody's got to originate loans differently from one another, right? We've got 147 different, types of fees, right? John and I were actually talking about this yesterday, right? Which is like one of the things that's super maddening and very, very difficult is we don't have a standardized fee structure, right? So if I look at one originator's LE and another originator's LE, they don't look this. I mean, the form itself is the same, but the content in it can be completely different.
When you say originator, you mean mortgage company?
Yes.
Okay.
So it becomes very hard to standardize a lot of that data, right? Like I feel like the secondary holy grail that everybody has been searching for is like automated due diligence, right? For residential mortgage-backed securities. And the quintessential problem that has always existed in that area is that everything is an edge case, right? It's like, it's just unlimited edge cases. And it's like, how do I take a 3,000 page file, extract all of the data from it, and then, test against that data set and feel comfortable in those results, that I'm now signing a 15E to the rating agencies. So basically, so everybody doesn't know what that means. So if you want to do a rated mortgage-backed security, you have to hire what's called a TPR, or a third-party review firm. That third-party review firm then has to sign a legal document called a 15E that is basically attesting to the results of their audits that goes to the rating agencies. And so in a world where, we talk about AI and data all the time, right? Like the AI is only as good as the data. And so this is where it becomes incredibly complex from that perspective to get something that works really well. The other thing that you just don't think about, or a lot of people, sorry, not you specifically, but a lot of people, is it's really difficult to get through vendor approval in an investment bank. Like it is, like, I mean, like, and I'm not joking, like there are some places where the process is 9 to 18 months, right? So I think that also kind of tends to scare some people away from the space, because it's like, if you go to an IMB and you're trying to sell them technology, depending on the size of the IMB, there might not even be a vendor approval process, right? Which, John, we'll talk about that later, I'm sure.
But those are two great points that go back to Mace's earlier question. It's due diligence and third-party review. Third-party review is just a formalized due diligence process where you're approved by the rating agencies. The getting approved by an investor or an issuer, and then being able to enhance due diligence and bring a better process forward. Due diligence has always been a cottage industry, meaning there's no public playbook on how to build a due diligence firm. It's always been insiders that learn the process, that break off and go create their own. Two of us are prime examples of that, right? Some of us, some of us are stronger at it than others, but at the end of the day, due diligence is a really interesting case, because to get investor issuer approval, you have to show the know-how, the competency, right? To establish that you know how to do the core functionality, and that then you have the wherewithal to support the particular issuer or investor's overlays, right? And the biggest barrier to being approved is, sure, you're approved by the rating agency, but that doesn't mean you could diligence loans the way we like to diligence them. And then the second issue is, there's historically, it's always been proprietary technology that diligence firms have used. There was a commercialized product that came to market from, the original due diligence firm. The CTO of the original due diligence firm built a commercially available platform, which allowed other firms to plug and play and then just throw people at the technology and say they're diligence firms. It's getting better. There's a newer market entrant in the last several years that Andrew and I leveraged, and went to market on the shoulders of. But diligence is industry, especially interesting as it relates to emerging technology, because automating, as you mentioned, Andrew, automating diligence is the holy grail. But the problem of the industry is nobody knows how to conduct diligence. They know how to key data into predetermined fields and have those predetermined fields calculate outputs that are due diligence outputs, but nobody knows why they're doing. They know what to do. They don't know why they're doing what they're doing. So I always imagine a world of automated due diligence, but it's got to come from, in my opinion, someone leveraging insider expertise on how to automate it. Because nobody, it's always the joke. I was actually joking around yesterday, is underwriting. We're of a generation, we're getting older, right? We're the last generation that knows what underwriting is. People say they're underwriters today, but they're data keyers. They're keying data into an AUS. They're keying data into an LOS. They're keying data into a due diligence platform, and they're underwriting. They're not underwriting, because underwriting is actually knowing what to do, knowing the math, knowing how to get to the outcome that the rating agencies want to see, that the issuers and investors feel comfortable with. So, I'm hopeful that due diligence will be automated, but I'm not holding my breath because once again, it's one of those industries that's so freaking antiquated that even off the shelf smart SaaS technology gives major uplift. There's such a chasm between where it is today and where it could be. But the challenge is very few people have the ability to bridge that chasm with the knowledge and to apply emerging tech and understand how to direct the emerging tech.
Yeah, I mean, that's perfectly said from that perspective. And it is Mace, like, it's kind of a joke in the secondary market. Like, everybody is Clayton alumni, right? Now we're aging out of that, right? Like, but John and I were both in Clayton in the early 2000s. I mean, sometimes I feel like half of the street worked at Clayton in the early 2000s. You look across the landscape, of all the big diligence firms, and you always seem to have somebody who came from Clayton, which was the original third-party review firm. And so John's completely right. Like, John, Clayton was huge at its peak, like 1,600 employees, maybe more. And so not all of them have left. There's actually people who are still there 20 years later, which is amazing to me. But a lot have sort of left. And so, to John's point, it's not written down. Like, how to do due diligence is not written down anywhere. Like, you just have to learn it. I don't know. There's no other way to put it.
And issuers and investors have to approve the diligence firm, which means that they have to get into the weeds and that they have to really understand that the diligence firm has the core competency. And taking a commercially available due diligence platform and throwing people at it doesn't always mean you have the core competency, because there's a massive layer of configuration that's needed on top of that the technology can't always solve for. So it's a prime area of the marketplace that's ripe for disintermediation. It's just a matter of having the right people and the right technology and the right time. And I'm hopeful that we'll be seeing something soon that's meaningful, because the gripes I hear from 2 degrees of Clayton, former peers of ours who have gone on to become some rather important people on the street, complain about is that the cost to purchase loans, the friction of purchasing loans, is exorbitant. We're talking about AI, we're talking about all this great emerging tech, but people can't do it right with plain SaaS. So how are they supposed to do it right with AI?
Right.
It's a conundrum. It's almost a catch-22 in many regards.
Well, and again, it comes back to the layer, right, of data extraction, right? And all three of us have talked about this, right? And again, I know I've already said it once, which is data is everything to AI. And Mace, one of these days, it would be entertaining for you to see what some of these files look like, because like these non-QM files can be 3,000 pages. And just docs all over the place. And it's like, how do you extract like, I gave this perfect example to somebody today. I was like, why are the bank statements in the loan? Like, you have to figure that out, right? Before you can, you can extract the data from the bank statements, but was the loan a 12-month bank statement program? Was it a 24-month bank statement program? Was it just there for the assets? Is it a DSCR? Like, I don't know, because you're just given this big loan file, and it sort of has always been like, go figure it out, sort of situation. So, and this is why, like, I'm always a little bit leery of what everybody is telling me, is I'm at the forefront of data extraction. Like, that's what we're worrying about. And I will tell you right now, extracting data from guidelines, just that, is extremely difficult.
And you throw in the use of emerging tech that's happening in the front end of the marketplace, right? Direct source data. That's a big thing right now. Bank statement information, employment, W-2 information, payroll information. Those documents are going away. Originators are starting to rely upon the Plaids, the Argyles, the MXs, and they're getting direct source data without the bank statement, and that bank statement is not in the file. So then that forces the diligence industry, the QC and diligence industry, to say, well, how am I supposed to audit this file if there's no document in the file? Because that's what I do. I look at documents, I take the data off the documents, and I put it into my system, and my system munges the data and comes to an outcome. And, Andrew, questions you and I have been dealing with, is how does the diligence firm confidently and comfortably adapt this technology that's being leveraged by the front end of the marketplace to allow the secondary market, QC, QA diligence firms to keep up and leverage that capability?
Well, and this is I'm gonna actually plug Daniel Hayes, if you're listening, comment, who started Greenline AI, right? This is a perfect example of someone who is really looking at this in the right way. So Greenline AI is a bank statement calculator. It uses only source data. And so they connect through the Plaids and the Argyles of the world. There's a few other in addition to that list, but what they do is they've created a graphic user interface that TPRs can then go into and audit the results of the actual source data. So they give you a visual representation of the source data to look through. And then on top of that, they do have the ability to create PDFs, right, of the source data, as it comes out. So a lot of times, the front end is, we always talked about this. The front end is sexy, right? LOSs, POSs, all of these things, right? But the problem is you don't have enough people selling front end originations technology, understanding the secondary market and the impacts that it's going to have. And unfortunately, what you also get is some IMBs who also don't understand that. Right. So now they go and they sign up for this flashy new software, and then they turn around and the loans go to get sold in secondary, because it's also because we're seeing a lot of originators who just were never non-QM originators, right? Who've always been like agency only shops. And all of a sudden they're deciding to become non-QM. So they're not accustomed to secondary sales. They're not accustomed to TPRs. And then they wake up and they're like, oh crap, like this TPR is pushing back because I can't actually produce the data for them.
And back to a reference you made earlier, what is a 15E? The 15E is a legal document that the SEC mandates that the diligence firms provide at arm's length. But what it is the legal attestation to the sufficiency of the review, meaning that what they did has to be determined to be sufficient by the diligence firm. They're attesting to what they did, the legal sufficiency of what they're doing, at the risk of criminal and civil liability, because the diligence outcomes are published in Edgar and become part of the prospectus of the bond issuance. It becomes a legal document. Investors rely upon that information to make a determination on whether or not to invest in that bond, right? So if the diligence firms can't confidently and comfortably do their job, and they're apprehensive, I would hope, probably not true, they're apprehensive to sign a 15E because they're on the hook in the event that bond deconstructs and that bond goes into litigation. Let's step back to 2010. Andrew, how many times were you brought into, asked to, be interviewed or deposed?
Unfortunately, not as much as you,
right.
Number one. But I got phone call. I mean, I think I got phone calls for like 5 years.
Exactly.
I mean, literally 5-6 years of, we're looking for the Andrew D. Good who worked for Clayton Holdings LLC from the years 2003 to 2010. That was a voicemail like at least once a week.
Exactly. And it's because investors are suing the issuer because the bond, in their opinion, was leveraging collateral that was not of the quality represented in the prospectus. So then, SEC came in and promulgated Regulation AB2, which made diligence firms a pseudo fiduciary, and this 15E is now an obligation. But the diligence firms don't realize if these bonds deconstruct, they have to come and explain to a room full of very expensive, very high-powered lawyers who are trying to figure out who has the capital and who did something wrong to remunerate their investor clients. And the diligence firms now, with the 15E, they're the first loss payees or payors, I'm not sure which one, in the event of a bond deconstruction. Because if they make a material misrepresentation, now that is a per se violation of law, and they are liable to the investors if they represented they did something, did not do it, and what they did was
I
deemed to be
think
not sufficient. There's a ton of risk, and nobody in the diligence space appreciates this.
just as John's talking, I'm just hearing the dollar signs. Like we want
Yeah.
to know why this is so expensive to to purchase a loan. It's because when the music stops, everybody's pointing their fingers. It's like heavily reminds me of the health insurance industry.
Totally.
Oh, yeah,
Totally.
100%. Well, and it's why like one of the most expensive things about starting a diligence firm is insurance, which is kind of funny. So pivoting a little bit, but I think this is important for anybody in origination technology who's listening to this or listens to it after the fact. Is really what I applaud Daniel for, and I think this is probably because he came through the Flagstar incubator, which rest in peace. That was such a friggin' phenomenal program. Sad to see it gone, but the fact that he did his diligence and in full disclosure, it was really largely thanks to John Levonick as well, because John's involved there. But he did his diligence and he had the conversations with secondary participants,
Yep.
right, to ensure that like he was doing the right thing by his customers as well.
Yep.
So let's pivot though back to the origination space. Is there any technologies in particular, like for the front end, that you guys are seeing, that are really interesting, or things, Mace, you come from the front end, like if there's things you're seeing that are really interesting, or things you wish you were seeing but were not?
Yeah, so as soon as you started asking that, I'm doing a plug here for
Please, yeah.
Diane Yu from she's the CEO of Tidal Wave, and Tidal Wave, she was formerly the CIO, I believe, at Better, and they are basically the interface kind of feels like ChatGPT, but when certain things happen, like you click, now we're going to ask you this, they kind of follow, it's kind of AI driven, and then they actually connect to the plaids and all that stuff while you're, kind of interacting with the AI agent, and they're taking off.
Nice.
And sorry, I'm hung up. I know you want to move on, Andrew. The key, Mace, Mace, a key thing to what you're saying is, right, you can always have the sexiest technology on the front end, but if you can't show your work, you can't establish as an originator that how you did something, and that what you did is accurate and consistent, it's going to impair that asset's ability to move into the private secondary markets, right? Fannie, Freddie agency delivery aside, we're talking about, PLS and like non-QM delivery. Originators really always have to keep in the back of their mind, in spite of the fact that as an originator, I could bring on great technology, the quality of my asset is only as true as I can prove to a diligence firm, prove to an investor, prove to an issuer, prove to the rating agencies that this underlying asset, this mortgage, was originated properly. It was originated in compliance with the guidelines. It met these obligations. And the problem with emerging tech, and I think this is going to be an overarching theme today, is that you need provability. You could have something so slick, something that brings such value, but it can't be black boxed. It can't be done in a vacuum where a third party can't come in and establish that what was done on the front end, the origination, is true and accurate. So I think a big part of the front end of the marketplace is, if we're offered any advice, if I offer any advice, is go get great technology, make your processes better, but you gotta show your work. You gotta show how remember fifth grade math.
Yeah, but I don't think
you can't just give me an answer. You gotta show me how you got there.
Yeah, but I think they are covering all of that, John. It's just how they're collecting it, right? Instead of it being a long process, right, or an old school. All right, sit down and start filling out this 1003. So I think it's just more of an interactive way, and all this stuff is still getting in there because it still is ultimately pushing to Encompass or whatever LOS, and it's still going through your typical processes. But I think the originators are having to adapt to get pull through and start winning these loans. I mean, I think we're starting to see that they're all having, Andrew, you made a comment, like people are starting to do non-QM loans who historically didn't, and it's because the pond is getting less water in it, and people are like, okay, I'm gonna they're not COVID loans where it's like, hey, if you're not a slam dunk, I'll let the next guy get it. And I do think that we have seen I've seen different trends in the market, like people complaining about trigger leads that have not gone away for 20 plus years. I thought, like, is this something new? And then seeing an originator complain about losing $5,000 on a deal. That to me was just pretty interesting, because I was like, EPOs, early payoffs, have been around forever, right? Like, I had to call someone and be like, "Is something changed?" And they're like, "No, just people are now complaining about it because the water's drying up." And so everybody's doing a little bit more, doing loans they historically wouldn't have, looking at technology to get increase that pull through. So I think there's a lot of, like John's hitting on, anything they can do to creatively get it on the origination side, and they're finding out later if they can sell it.
Well,
where the puck is going. Sorry, Andrew, to jump in.
Okay.
I just find something May said. It's a good point. As the front end becomes more automated, it comes down to trust in the data, right? So it's not a point, it's not a fait accompli if it ends up in Compass, right? That it's truly accurate. And I think the future of diligence is not going to be in verifying the independent data fields anymore. It's going to be verifying more of an operational perspective. Did that data come in from the source and end up in the LOS and end up on the documents in a secure manner where it was unchanged? Can that data point be trusted from inception? Meaning, is there a man in the middle between the plaid and the encompass, right? Was there a chance for that data to be corrupted intentionally or unintentionally? Because once again, you just can't trust because it comes from plaid, it's absolutely true. Or can you?
Blockchain. Did I say blockchain?
Where's Ian? We need to reel Ian back in.
Come on back in. Let's go. Who's gonna make them? I'm not gonna do it, but if there's anybody out there, I highly recommend an AI blockchain LOS would be like the bomb right there.
You're going to be hearing the term data provenance, right? And that's the underlying concept you're referring to as blockchain, Andrew.
Yeah.
Is proving the provenance of the data. Is the data that was processed and ended up on the final documents true to the source, right? Was it messed up, or was it lost, or was it changed at some point? And if you can establish it wasn't, if you can prove the data provenance as it resides in the documents, that's the future of quality control. That's the future of due diligence.
Right. But I think ultimately, at the end of the day, an AI native blockchain loan origination system really solves for some that is based on digital source data, right? Solves so many of these problems and has the ability to really speed it up. But
you need to bring in someone from the CS department at Stanford or Penn or MIT and grab one of those young folks and say, listen, here's the problem. Go fix it. Because I hate to say that, Andrew, it's not going to come from an industry insider. That is such a revolutionary change that I hope comes, but it's got to come from somebody that knows what the heck they're doing.
Well, the other piece of this is what's going to be interesting is, and I'm not going to disclose the name, but I met with someone yesterday who was the co-founder of a very large, now very large originations firm. They left that origination shop years ago, working on a new project, and it's really, really fascinating to listen. This is someone who is crazy smart, who has been in the industry for a while, and they're so thoughtful about what their tech stack is going to look like. But again, they understand front end and secondary market. So their approach to their tech stack is very much in that vein of how do we get as fast as possible to securitization? And this is I don't know if problem is the right word to put it, but when you have a lot of originators who have only delivered to Fannie and Freddie, that's all they know, that's their life. It's really easy. I mean, I don't know. I've never been on the origination side, but I assume
it's at least easier.
It's much easier to submit a loan to Fannie, right? Now, you obviously you have the the chances of a putback are much, or what do you guys call them?
A material defect or a scratch and dent loan.
you have a much higher chance of having a repurchase on a Fannie or Freddie loan because of the nature of the process, but it is much easier to get a loan delivered. Whereas when you start dealing with the secondary market and you have to start dealing with overlays, you have to start dealing with diligence, you are way less likely to get hit with a repurchase. But on the flip side of that, you do run the risk of a loan just not being bought, right? Because of the due diligence. So one of the things that like I wish was being seen more, and I don't think it is if you're a new originator who is moving into non-QM, and particularly if you're doing like bank statements, DSCR, like stuff you're not used to as an originator, and you're not hiring someone to be doing pre-approval diligence or pre-closed due diligence, like you're making a major mistake in my eyes.
What investor would take new product from an originator, that is new to the space and accept their product without doing a certain, 100% of, a certain amount to get comfortable with that originator's ability to manufacture appropriately, right?
John, how many mortgage companies do you know of, IMBs, that were like, hey, we're pretty good at this, let's go try TPO, and then that you see how that goes. Then you have these wholesalers, I know Stearns Lending, they tried going into retail twice and they kept failing, but they're like, we're really good at this side, and so they're like, we'll go make money over here, and until they end up buying a mortgage company.
It's sort of like I'm really good at baseball, so I must be great at hockey.
Yeah. It's Michael Jordan. Yeah, they're like, I'm Michael Jordan.
But you're right, though. It's, the inherent challenges. IMBs have been delivering, in my opinion, a disproportionate amount of volume to Fannie and Freddie agencies because it's easier, right? They get a lower execution, but a higher pull through, right? And the one-off repurchase or EPD that's going to come back to them, it's worth it to them to have versus having 1 in 5 loans that are going to the private capital markets being kicked out of a trade for a scratch and dent that's deemed to be, not saleable or saleable at a heavy discount, right? So IMBs are terrified to deliver to the private capital markets, right? So whoever can master the process of bringing the investor requirements down to consumer engagement and control that process is going to nail it down. People have asked me, what do I see the future of, IMBs delivering to private capital markets? It's investor conduits. The investor is going to want to control the process. Is it like a wholesale or TPO model where it's non-delegated TPO effectively because the investor wants to see that asset, wants to sign off on that asset, or deem, they want the sufficiency of the quality to be signed off on in advance of acquiring it, either by a diligence firm or internally.
Do you see the number of vendors? I've kind of seen mortgage companies be a little frustrated with vendors, and I feel like it's partially, with the them looking at the cost to originate a loan, right? They're just immediately like, okay, who can we cut? Do you see more of our big vendors kind of touching into other pieces of software or other parts of the process, or do you see some of these larger firms doing more stuff in-house, I've talked about with you, Andrew, extensively what the things we were able to do, hey, let's just go ahead and get rid of our CRM. Like, we're using these 3 functions, but we're paying $150,000 a year, so let's go build that in-house real quick. And so I think you might have some of these really proficient a group of 5 guys that'll be your kind of your SWAT team that can turn around and be like, things like building an LOS, right? I'm not saying to go do that, but whenever I think about doing that, if anybody's ever talked about building one, it's the integrations, right? When you're trying to make it work I need to make this work for 500 different types of companies because they all do things differently, as we've talked about. And then this credit vendor, this appraisal provider, this appraiser, this, all these different doc vendors, compliance engines, pricing engines. But if you're just going to go in and be like, I just want it to work for me, I'll just go build my own solutions.
There's going to be a lot of disruption in certain technologies because of, God damn it, I can't believe I'm going to say this word, vibe coding. I met with somebody else yesterday who they built their own POS. They were like, we knew exactly what we wanted. We wanted to go about it this way, and we just made the decision that we were going to go build it. Right. The reality is, and Mace, you'd be able to tell me if I'm wrong here, but like going to build a CRM, like we use HubSpot. It's got like 90,000 features I don't ever use. Right. I use 6 of the features I feel like in it. Right. And so, can you go build a CRM that just accomplishes like the 6 features that you use? I think where coding is headed, it's becoming easier and because you're not looking, when you're an IMB, you're not looking for something that is like massive enterprise scalable necessarily, right? So there are certain instances in which you can do that. I met with a trader, Jason Savage, John, Savage. I met with him yesterday afternoon, and he was telling me about shit he's doing where he's just building it himself, right? And he's like, he told me, he goes, I have no idea how I was in this industry without ChatGPT. That just happens to be the one that he's using. But it was pretty amazing to hear, and this is not somebody who's an engineer, right? And to hear like the things that he has figured out to build on his own has been pretty impressive. So I think where maybe security is not as big of an issue, and where you don't necessarily need to worry about scalability, you're going to start to see a lot more like in-house build where it's not super complicated. And that's why I use like the CRM is a good example. It's like, well, let's be honest, it's a backend database. You're collecting data, and then you might do something with said data, right? Maybe an integration or two, but we're not talking about something that's this like massive undertaking.
Yeah, it's an excellent point, Andrew. Banks, mortgage bankers are becoming tech firms because the cost to originate is exorbitant. The number of different vendors who touch a loan as part of the manufacturing process or the sale of the secondary market is growing, and it's you think of it as a large pizza, right? It's a set size, but they just keep cutting the slices smaller, and everyone keeps getting a smaller slice, but the pizza's not growing. So it makes sense for a lender. A lender's got to become a tech company. Diligence firms have to become tech companies. If you're not a tech company, I get companies come to me to kind of want to show me their tech and show me what they're doing, how cool it is. My first question is, how do you reduce the cost to originate? Are you compressing and consolidating spend elsewhere into your service, right? A good example is, and another thing you and I talked about, Andrew, is docs to data. I laugh. I see companies out there that are just doc to data companies, and they're charging for that. That should be a value add to an overall service. That shouldn't be a freestanding service in and of itself to have has its own revenue or its own cost point.
But see,
right?
So that's the thing, John. I was talking to the CEO of a very large mortgage bank in Texas just last week. It's funny because you just said that, and I think that's the double-edged sword that the tech companies deal with. Is like one CRM has slowly grown to offer 90 features, and so they want to charge you for 90 features. But Andrew's like, I just want these 3. Right. I want to pay 30 cents.
Yep.
But then, like John, you just said, then you can do one thing where you say like hyper focus. Well, then Andrew's like, well, I got to go get 3 different companies if they only did one thing each. And so it is kind of a, like you, John, it is funny to say that, I agree with you. It shouldn't just be one thing. But then I think when we look at the number of features that you want to kind of one off and do, right, instead of trying to pay for a big pie, because I've noticed I've been on conversations with vendors talking to the lender, and the lender's like, I want my price to be this. And they're like, well, no, you're not using all the features that we have to offer. And the lender's like, I don't freaking want those. I just want these 3, and I want my price to be paid for those 3.
Every technology vendor, every service provider out there wants that technology valuation. They want that 30x EBITDA valuation, and they're trying to build a tech company with a massive valuation. So you're seeing, and I know Mason's going to touch on a sore spot, right? You're seeing 3-year contracts with mandatory minimums and liquidated damages clauses to get out of it with prohibitions on using a competitive product, right? Well, what happens when volume drops off? Well, they still have to, lenders still have to pay the minimum, even though they're only originating loans below the minimum, right? Until the industry changes and provides a la carte pricing with no draconian minimum contracts and purely compete on capabilities and value add, we're going to be stuck in this cycle of this conversation,
Right.
and I agree. I saw recently a early stage LOS POS, right? Whose first advertisement is, we don't have minimum contract obligations. Use us on demand. Just pay us for use. Pay us a success-based model, right? No overly expensive integration costs,
So
right? No deep hooks where we can't, if we don't do a good job, just replace us. And that really motivates the technology company.
I got to plug Mace Innovations here. Free trial, month to month, no minimums. We do that, John.
You guys should take sponsors. Jesus.
I'm going to chime in on that one. We're a little bit different, right? Like what we do free POCs, right? We do have kind of minimums in our contract, but what we do is we look at the client and, let's say you're doing 10,000 units and that's like your lowest month, then we'll look at it and go, okay, we're going to set the minimums at 5 or 3. Right. So, but to your point, John, we have that, like, if we suck, you can fire us clause in the contracts as well. Right. Like, I think that's the important thing is how much of a partner are you in that particular relationship? Right. Ours is also a little bit different because, the one thing we've really come to learn with AI agents is that, like, there tends to just be customization. Right. It's like we have everything's about 80% out of the box, 20%, then has to have, some level of customization. But I am with you in the fact that, like, these contracts where it's like you can't work with a competitor or you can't do this or, whatever, like, is absolutely ridiculous. Because if you suck, and you should have to if you get beat by someone, you get beat by someone.
You might have hit the nail on the head with one of the key reasons to why technology in our space is so behind the times, because the technology companies are not incentivized to be better, faster, and cheaper than their competitors. They've got the contractual protections and they don't have to evolve. They don't have to evolve quickly because they've got the contractual hooks, knowing that if it's a lender, their lender's stuck with them for 36 months. And if they want to go away, they have to buy their way out. And that's just ridiculous. And that's not the way of the future model. As we move towards more of an open source type of mentality, a pure consumption, methodology, I hope that technology companies will start competing on providing better pricing, providing, more tailored features and functionality to the end user, not making them purchase, a product that 80% of the key capabilities are sitting on the shelf because they're not of value.
Right.
So I'm hopeful that founders, and soon to be market entrants in our space are hearing us right now. How you construct your economics and your go-to-market value proposition will really dictate in the long term your success, and probably in ways that they're not thinking that it will.
Right. No, absolutely. Real quick, so that I don't put you on the spot at the end of this, John, you are going to be the one responsible for asking the question for the guest for next week. Next week's guest, I'm actually really pumped about this. It's Diego Sanchez, the president of Housing Wire, is going to be joining us. So you don't have to say.
I know my question for him already.
Okay, we'll leave it for the end because it's easier for me to edit at that point in time for your voice. So moving from there, are there any other arenas that you guys are seeing or things that you're seeing that people are working on on the front end originations area? Like,
I had the luxury of being at least likely place to see emerging tech, right? Mortgage Bankers Association Legal Issues Conference last week in San Diego. I know a bunch of compliance persons and lawyers.
I didn't even know it existed.
Yeah, it's
Nor should you really, Mace.
it's like the annual opportunity for everyone to get together and hug it out and then go back and compete for the next 11 months and 28 days. The
So,
the wh- every time I go to these conferences, there's always a focus on AI, right? AI is the buzzword. But the common theme here is that there's a lot of companies out there working on the efficiency and the efficiency associated with emerging technology in manufacturing, right? Obviously, the common theme I'm seeing here is that, all right, the LOS experience is not changing and it's challenging. And then every technology I see is looking to sit on top of that really challenging LOS process to make the experience better, to make it more intuitive, right? Where the industry is building ancillary tools to make a really bad process better versus stepping back into what was said earlier, say, well, why are we building a tool that sits on top of something that is challenging at best? Why don't we take the next step and just work to replace that challenging core technology? You know, I don't mean to throw the LOSs under the bus, but I kind of am here. You know, there's a handful of them, and they're in my opinion, a little bit behind the times on delivering thoughtful emerging tech as part of their core platform. I don't understand why. They deliver a highly configurable tool that implicitly there's power and configurability. You know, I think it was said earlier, I have no idea why there's 30 or 40 different ways to manufacture the same widget against the same specifications, right? The same guidelines. But this world of these ancillary techs, they're awesome, they're great incremental value adds. But where is that mind-numbing step back to that digital native experience and rewriting the process from how it's done?
But aren't on some level, and I don't mean we're not, for all the LOS people out there, we're not trying to trash you. You're integral part to this industry.
Absolutely.
But tell me,
I was one myself. I can't knock it.
Oh, that's right. I forgot. Oh wow, that was a really long mortgage cadence. I had hair when John was at mortgage cadence. Maybe not. Maybe it was gone. But you could almost sort of point at the LOSs as being too configurable, and that's really kind of almost tell me another industry that as a platform as core, right? Because like without the LOS, nothing happens, right? Like we all agree, like that's the core of all, and it's why people talk about it so much, right? But what other industry has a core technology like that is that configurable? Because John, you said 30 to 40 different ways to originate a loan. I'd push back. I think it's higher. I think it's probably 100. You know, like
I think that, like I said, Andrew, I kind of touched on it earlier. Like that is the problem, is that they have to cater to 1,000 different personalities and that want 1,000 different features each. And I think that, and then like, well, I use these people for credit. I use these people as my point of sale. I use this doc provider. I use this compliance engine. I use this product and pricing engine. And then they say, well, fine, we'll make our own pricing engine. And then I think now, this is what I was kind of hitting at earlier, Andrew. Now, I think the LOSs would kind of offer a pricing engine, and it was kind of like, oh, that's kind of for your, I do less than 20, 30 loans a month, so I'll make it work. I need to go get OBE or something else. I think we're going to start seeing some of these big LOSs embrace, or they're going to have to, I think, start embracing this AI to, I'm not going to say it, AI to code. I'm not going to say vibe code, but using AI to increase their efficiency at coding, and then actually have a good bolt-on like product and pricing engine, for instance.
I agree. And I think they need to take certain capabilities away. And there's a really particular thing that has always bugged me. Andrew mentioned points and fees, how points and fees come in all these different shapes and sizes, right? I look at loans that are defective a lot. I try to figure out what happened and if it's defective and why it's defective. And a big area for a long time, especially when rates change, are discount points and the treatment of discount points. And without going into the over the top on why, but a portion of discount points can be excluded from the key threshold calculations if they're deemed to be bona fide, meaning have a one-to-one basis, they have a correlation to reducing the interest rate. But there's a portion of discount points that might not be bona fide, right? So someone's got to look at the origination fee or the discount points and say, all right, Is it all bona fide? What portion's bona fide? And you know who has the ability to make that determination when you're manufacturing the loan?
LOS.
One of the least skilled persons in the manufacturing process.
Right.
It's sometimes it's a radio button. All right, here's $10,000 discount points. Enter in what portion is bona fide, and you've got an underwriter, you've got a processor. Now, I mean, underwriters are at least capable and skilled, but you've got these individuals making a determination of what is and is not bona fide. As a compliance lawyer, that terrifies me.
Oh, John, I would argue that 1 out of 10 underwriters could actually tell you what a bona fide discount point is.
See,
Y'all are gonna get all sorts of hate mail.
Dude, no, I know the screen in Encompass, and it tries to almost explain how bona fide discount points work and how the calculation works. But as far as underwriters, dude, they don't know what a bona fide discount is. They're just
John, don't you remember the old days at Clayton where like all of our underwriters on the floor had to understand like how to split out?
Yeah. But why can't there be a bolt-on tool that's a bona fide discount point calculator?
There you go, Mace.
Put your baseline pricing in, put your LLPAs in, and let the tool determine in an automated, consistent fashion which portion is bona fide, which is not.
So they have that inside of Encompass, John, and I think I've even seen people that are just like, oh, we have this error that we usually see. It says bona fide discount error calculation, but we just don't pay attention to that.
Is it optional? Why is it optional? Why is it optional?
Yeah, like there's again sometimes when people say we do things differently, I just want to slap them and be like, you do a lot of things wrong. Well, and it's funny because Andrew, I think I've talked to you about this. Freddie Mac, you can Google Freddie Mac cost to close a loan study. Last year it was like the top 25% people of originators, it was about 10 grand, and then the bottom 25, because you hear this number all the time, right? On LinkedIn, I think I see it. I think I'm going to start keeping a tally of the cost to close a loan is this, and everybody ranges. And that's the important part, is it is the giant range. And so the bottom 25% was just at like 17,000. So we're talking about almost 100% difference. And the funny thing is that it wasn't only the big guys who were like really putting in features for getting the economies of scale. The size of the company wasn't really a big factor on the cost to close a loan. It was just purely what inefficiencies were they doing. And like,
yeah.
So Mace, you just gave me a great idea. Is I think I need to create a bingo card for mortgage lingo on LinkedIn for every time that we hear those exact different things, right? So it's like, what do you think interest rates will be over the next 6 months?
Oh gosh,
I saw that one again earlier today. Okay, we're almost out of time. So since we're at the end, what?
That's too bad. I could do this all day. This is awesome.
I know I have to do other things while I'm here in New York too. Mace, what's a real quick interesting way you're using AI right now? Do you have anything from in the last week that you've been doing that was sort of, and it can be personal, it can be whatever.
Oh, and last week, remember I talked about the having to learn how to talk to my daughter about putting a bird out of its misery. So there's that. But
that's a good use.
I would say today I used it to look at stuff we should talk about. But no, it's been vibe coding. I mean,
so yeah,
it's just too good.
Mine was as some people know, my son has, it wasn't because of me, has become this sort of budding track star who has a shot at maybe running in college. And so I don't know anything about the college process, right? And I sure as hell don't know anything about if you're going to be a collegiate athlete, right? So I've started using GPT to sort of help me understand what should I be doing to prepare now? When should I be taking the next steps? What do those steps look like? So it was just a really good personal use. John, what do you got?
Yeah. You know me, I like to put content out into the sphere. LinkedIn, our industry's become a content heavy perspective place. Lately, I've been taking articles or posts that people have put in there that's really thoughtful and deep and intense. And I capture them, I run it through ChatGPT, for example, and say, was this created by ChatGPT or was this created by AI? Because I'm trying to find out who's full of shit and who's not in this industry. There's a lot of people over their skis, and the stuff that they put out is like, all right, is that really that person, or are they trying to look smart through the use of AI?
Well, fun fact, if you copy and paste from ChatGPT, there are hidden special characters, and LinkedIn actually will pick up on those special characters.
Ooh.
And will push down the views that come in. Okay, so we're going a little bit over. So last thing, John, what is your question for Diego Sanchez next week?
There couldn't. This has been on the top of my mind. So this is just an unbelievable opportunity. Our industry unquestionably is tied to public policy. The future of Fannie Mae, Freddie Mac coming out of conservatorship, examination, regulatory oversight. There's a correlation between politics and policy as it directly impacts our industry. And this is one of the things I admire him for. It's really hard to have personal ideology and professional needs. Diego, how do you process what's going on in the political environment as it relates to ideology, which has a direct impact on our industry, and reconcile that against personal beliefs?
All right, that's a good one. So I can't wait to hear.
I'm going to tune in just for that.
I'm going to have to give Diego at least like a 5-10 minute window to be able to answer that question, I feel like. So, all right. Well, for everybody who's watched or does watch later on in the recording, thank you so much. Leave us a comment. John, thanks again. Really appreciate you stepping up and stepping in for us this week. And PK will be back from his 17th vacation this year next week. I'm just kidding, PK.
I want to be PK.
Everybody wants to be PK. There's no question about it. So, all right. Thanks, everybody, and see you next week.